Hello and welcome to Business Morning. I am Bisi Adebayo. In this move at its fifth meeting of the year, the Monetary Policy Committee of the Central Bank trimmed the benchmark interest rate by 100 basis points to 11.5%, the lowest rate since 2016. The committee also adjusted the asymmetric corridor to plus 100 to 700 basis points around the MPR from plus 200 to minus 500 basis points, while keeping the CRR at 27.5% and liquidity ratio at 30%. But ahead of that meeting, the expectations of these adjustments within the analyst committee was mixed, considering the continuous rise in headline inflation and the level of money supply in the economy. But joining us now to make sense of the MPC's decision is the head of portfolio management at Commercial Partners Asset Management, Victor Alui. Many thanks, Victor, for joining us on the program. Now, let me start by asking you.
Thanks for having me.
All right, let me start by asking you if you expected the rate cut from the CBN MPC meeting by as much as 100 basis points or not.
Well, I think, like you said in your opening remark, it was a largely unexpected move, and it was basically on the back of the fact that, a lot of analysts did not see that the Apex Bank was going to cut that significantly. But I think what the Apex Bank did with that, reduction is a strong signal and a strong posture to indicate that it is more concerned about reflating the economy and, creating the right environment for output growth to thrive. Recall that our economy has been essentially on the mend. When we started 2020, we had a 1.87% GDP growth in Q1, but of course the whole COVID-19 pandemic with its attendant impact saw a 6.1% decline in Q2. So, for the Apex Bank, the core mandate is price stability with regards to inflation and exchange rates. But of course, if you pass through the communique, you would see that the continuous rise in inflation has essentially been on the back of structural issues, not necessarily issues that have to do with monetary policy. So, and that's the reason we're seeing, the Apex Bank addressing that with what you might describe as unconventional or development finance tools, because as long as those bottlenecks are addressed, then the inflation situation can improve. So the 100 basis point cut wasn't expected. That was not what a lot of analysts had, hoped for. But again, it's just a strong now from the committee that output growth right now is on the front burner.
Now, one thing the committee referenced was the uptrend in consumer prices, but then it also noted that it's not as a result of money factors. Do you agree with their views?
Absolutely. Inflation in Nigeria is typically as a result of, supply disruptions, which largely then leads to cost. So our inflation is largely cost push. So a lot of the inefficiencies, a lot of the bottlenecks, a lot of the supply side disruptions and disruptions are the factors that really creates this inflationary trend. And monetary policy wouldn't necessarily address how to essentially address that is to use policies that would detangle those bottlenecks, that will make this move more smoothly, to ensure that there are little or no disruptions that would enhance the supply side, and we'll see some sort of moderation. So I agree that these are not monetary related factors that have led to the uptrend we've seen in inflation, and using monetary factors to address them would not achieve much, and that's the reason the Apex Committee decided to go the path that it did.
Now, how is this decision being perceived across the investing community? Of course, is it seen as a plus for Naira-denominated assets or otherwise?
Well, if you look at the straight impact at yesterday's auction, particularly the bond auction, we've seen yields decline. That is expected, really. The equity markets, we saw market up about a third yesterday, not necessarily directly linked to that issue. But generally, I think that what that has done is to further push yields downwards. That's the impact that's seen. Again, most analysts, investing community did not expect that we'll see that quarter, not even as much as 100 basis points.
But do you expect local investors to start considering the Eurobond markets, given the similar level of yields in both local Naira-denominated and Eurobond?
I think that has actually been a trend before now. The yield, the Eurobonds have essentially been around almost level with the local bonds, and then if you consider the current situation, it makes the Eurobonds a bit more attractive. So that has been a trend for now, and I expect that is even likely to continue.
Just a few weeks ago, Victor, the CBN also announced a reduction in interest rates and savings deposits from 30% of MPR to 10% of MPR. What effect would this benchmark rate have on savings that's going forward?
I mean, just be direct. Really, I mean, basically, is that since rate basically dropped about just like 1%, for the average saver, it basically means that you're earning less on your savings. But from the bank's perspective, it will basically speak to a reduction of their cost, particularly for those banks that have a huge mix of savings and current account deposits. They are going to benefit quite significantly, and that should also sort of boost their net interest margin. But again, consider the fact that, the yield on assets is also trending downwards. Maybe that could just offset it and we could have zero-sum gain. But generally, it just basically implies that, savings or the earnings of savings will also even reduce further.
Do you see this as a step, or do you see this step rather as a strategic decision of government to brace up for return to the Eurobond markets next year?
Not necessarily. I think that what the Apex Bank has done is to prioritize output growth to ensure that Q4 or Q1 in 2021 would eventually return to some semblance of growth. Remember what the Apex Bank is doing now. It's seen about 3.5 trillion worth of direct tensions in various sectors and various aspects of the economy. The idea is to try and stave off or ward off the potential impact of the COVID-19 on the economy and also the slowing down of the global economy as well. So what the Apex Bank is essentially doing is to prioritize output growth, and I think that it's a step in the right direction at this time.
Now, just before I let you go, Victor, tell us what are the fiscal measures you expect to complement this rate cut decisions in order to further stimulate economic growth?
I think on the fiscal side, things are significantly changed, particularly from a revenue standpoint. And that's the reason you're seeing the Apex Bank step up to do that it's doing. The truth of the matter is that the sort of collapse that we've seen in crude oil prices, yes, we've seen some recovery over the last couple of months, but you certainly cannot compare the sort of revenue we are seeing from that front to what we were seeing last year. Again, as a result of the significant economic downturn, obviously it will have negative impact on tax revenues and all of that. So on the fiscal side, there's a strong revenue chart, and it significantly limits, what the authorities can do, at least for now. Nevertheless, I think the idea would be to align and coordinate with monetary authorities to ensure that there is robust support for the real sectors in the economy. I have then juxtapose that with the idea that the fiscal authorities also want to earn more in terms of revenue, particularly from taxes and all of that. So do you want to tax more at this time to earn more, such that businesses and corporates suffer? This is not it's a simple decision, really, and challenges on the fiscal side will be with us at least for another 6 to 9 months thereabouts.
And our portfolio management at Commercial Partners Asset Management, Victor Aloyi, thanks for sharing your time with us.
Thank you.
Now, let's update you about the latest development in the crude oil markets, where prices declined in early trade today, weighed down by concerns that U.S. economic recovery is slowing as the coronavirus outbreak lingers, while a renewed wave of COVID-19 cases in Europe have led to reimposed travel restrictions in several countries. U.S. WTI crude futures fell 0.9% to $39.56 a barrel, and Brent crude futures were down 0.8% to $41.43 a barrel. Suggests all the demand and economic outlook due to the coronavirus resurgence have prompted a rally in the dollar as investors turned to safer assets, adding pressure to oil prices. We know that the strong dollar makes oil priced in U.S. dollars less attractive to global buyers. Of course, we'll talk more about the crude oil markets later on the program. But meantime, in its latest assessment of the effects of the pandemic on the world of work, the International Labour Organization says that the global labor income is estimated to have declined by 10.7% or $3.5 trillion in the first 3 quarters of 2020. And according to the ILO, the big decline is in the lower middle income countries, where labor income losses hit 15.1%, with the Americas hardest hit region at 12.1%. ILO further reports global working hour losses of 12.1% or 345 million jobs for the first 9 months of the year, based on a 48-hour working week, and projects worse than expected 8% working hour losses for the fourth quarter of the year. But let's now join research evaluation consultant and policy analyst for Government Nigeria, Femi Balogun, for some insight into this report and other developments in the jobs markets. Good morning. Thank you for coming on the program. Well, what do you make of the report, and how can low-mid-income countries break out of this quagmire?
Good morning, and thank you for having me. The monitor report by the ILO is a very interesting one, which already tells us things that are happening with low and middle income economy. But I think it is important to know that the region that is most hit is in the Latin Americas, where the COVID incidence is quite high. That does not mean that parts of Africa is not involved in this, but because what we are seeing within the market is, particularly in some parts of blue collar jobs, when we talk about those in the transport business, those that are in the hospitality and even drivers, for instance. Many of them are seeing low working hours, and as a result of that, their income has also reduced. In the white collar section, we are seeing, particularly within Nigeria, we are seeing that teachers have become hardest hit because schools are closed, and so teachers have practically earned very little income within this time. And I think that report highlights significantly some ways in which Africa broadly lower income, middle income countries are affected by pandemic.
Speaking of the working hour losses now, is that the picture of what the experience is in Nigeria?
Well, yeah, like I've described. Yes, we are seeing them in particular sectors, especially the hospitality. We have restaurants now and hotels who have had minimal businesses, and many of them have had to ask some of them have to go. And then in some other businesses, there are some businesses that are not able to move their operations online. Many of those businesses have been affected by this wages.
Nepotism is a big issue in Nigeria, and it can be said that this is one of the many reasons that youths are not getting jobs in the country. But how can employer and government create equal opportunities for all?
Okay, so at this time, I think we are seeing a report by the National Bureau of Statistics, which suggests that unemployment has dropped from about 21% to 27%, and we have larger of people who are young people are unemployed, 40% to be specific. The focus for government, in this particular time, is to provide safety nets to help young people find jobs, and connecting them with emerging businesses that have come out as a result of COVID-19. Yes, COVID-19 has resulted in business losses, but at the same time, some new businesses and some new roles are already emerging. For instance, we have a spike in demand for customer care agents. We are having new roles as social media managers. There's huge demand now within the digital space for software engineers, who can automate processes. There's also demand for digital marketing experts who involve social commerce. So there's a huge shift in terms of jobs that are emerging, and so it's important for us to pay attention to these emerging sectors, provide policies and incentives to help these businesses so that they can also create jobs for people.
Now, the sixth edition of the ILO Monitor also looks at the effectiveness of fiscal stimulus in alleviating labor market impact, and recommends that in order for developing countries to reach the same ratio of stimulus to working hours lost as in high-income countries, they would actually need to inject a further $902 billion. How is it possible for the Nigerian government to realize this?
It's a huge task. That's almost a trillion dollars, and we have limited capacity to locate this kind of funding. So government cannot do it alone. Private sector has to come in, and so I think it's important for us to have dialogue at this time and having an integrated approach that brings together government, private sector, and development partners as well to find specific solutions, because we cannot. It's not a one-size solution. All of sectors, different sectors will need specific kinds of solutions. For instance, the creative sector perhaps is one of the hardest hit. We have entertainers, comedians, musicians who have had low business turn up in time. So the solutions that the creative sector will require will be quite different from the solutions that hospitality, the hospitality sector, or the agricultural sector, or the digital sector will need at the time. So dialogue sectors will be something that will be very useful at bringing together government, private sector, and developer.
With employment and underemployment reaching an all-time high in Nigeria at over 40%, of course, due to the pandemic, we're seeing this jobs become an overcrowded marketplace with 18 to 35-year-olds mostly impacted. So how can young job seekers stand out this period?
So your jobs can stand out within this period, by paying attention to the market. And some of that information is what we have been observing, in the last 9 months. We are seeing that, employers are now beginning to demand beyond technical skills. Now they're beginning to demand soft skills, softer skills, critical thinking, creativity, innovativeness, communication skills, and that's part of the services that we are providing for free at this time, helping young people develop these skills, because that is what opens the doors into the job market for them at this particular. Another thing is, that we are trying to help give visibility to some of those young people that we are training, and as well making available job listings at the same time.
Research evaluation consultant policy analyst for Job Urban Nigeria, Femi Balogun, thank you for sharing your thoughts on the program. We'll be talking commodities when we return in just a moment. Please stay with us. The head of research at the financial derivatives company, Damila Akibami, is now to discuss the burning economic issues at the domestic commodities market. Good morning, Damila. Thanks for coming on the program.
Good morning, BC. Thank you for having me.
Now, many people didn't see it coming, and I'm referring to the MPC cutting the MPR to 11%. And of course, you guys at the FDC also predicted that they will maintain status quo on the rate. So how did you receive the news?
Like you rightly said, it was unexpected. Most analysts were anticipating that status quo will be maintained. But what the CBN has done, basically, it has prioritized stimulating growth over ensuring price stability, both in terms of inflation and exchange rate. And what we've seen with the adjustment in the asymmetric corridor on the MPR is basically the range between the placement borrowing rates have been widened. And for banks, what it means, they might see some increase or be marginal in the net interest margins. But definitely, it's clear that the CBN stance is aligned with what the government is trying to pursue, which is in terms of trying to boost the agricultural sector, trying to ensure that food self-sufficiency is achieved in terms of food production. Because you see the Nigerian story import a lot of food items. So the government, especially the center, trying to push this mantra of grow what you eat. And so what we've seen right now is that with what the CBN is doing with reduction in interest rates, with the fact the CBN has even told banks to increase their exposure to the agricultural sector from 4% to 10%. And even now the CBN is saying under its anchor borrower program that is going to split the risk of lending with farmers 50-50. Basically, what they're just trying to do is to try and boost yields, to increase local production, and that will reduce food imports. Right now, food inflation is around 16%, and that is the major driver of the basket. So with all this being done, we expect to see that at least the impact would be positive on food prices down the line.
And still talking about the impacts now, how do you think that investors and markets react to this?
Well, the thing is, what the CBN is saying, the message that is being passed across and the signal, you will see there's some conflicting signs. And for investors right now, that when you see conflicting policy signals, you tend to stay back and it creates a lot of uncertainty, and it dampens investor confidence. Take, for instance, even what is happening in the Forex market. On one hand, you are trying to boost Forex supply. On the other hand, you are increasing the administrative control. So it's sending a lot of signals for investors, especially the time is heightened global uncertainty. Even if an investor is looking into the Nigerian market, the fact when your rates are becoming more unattractive because the interest rate or the real returns on investments have been in negative territory, and the fact that you've cut your benchmark by 100 basis points further with inflation at 13.22%, you're pushing real returns further into negative territory. So definitely that would with investors. So there's the fact that there's a lot of ambiguity and confusion in terms of policy signals. So it's not a good signal to send to investors, especially at this, because again, this CBN, you're trying to attract capital inflows because the external reserves today they're increasing, tomorrow they're depleting based on the information being published on CBN's website. But the fact that our major forex supply or source of forex, which is oil, well, we've seen a sharp decline in oil proceeds. So you need to generate as much revenue, as much reserves as possible. So another form of getting that from forex is from investors' funds, because remittances, which is another source, we know that is sharply declined because of high unemployment globally. So right now, it's not sending the right message. But then again, are prioritizing out at the cost of rising inflation and possibly exchange rate stability. So it'll be interesting to see how that plays out next couple of months, at least pending the next meeting holds in November.
Absolutely, we have our fingers crossed. But let's talk about oil prices now. Of course, the volatility there continues, and this means we saw Brent at about $1 a barrel. But apart from a decline in Chinese oil import, what factors are driving the market currently and its implications for Nigeria?
Well, for the oil market, it's predominantly weak demand, and even basically that same factor that is affecting practically almost all commodities, despite the fact that we're seeing that countries are beginning to reopen, we're seeing this gradual pickup in recovery. It's still way below the supply surfeit we're seeing in the market right now. And for oil prices, we are saying that for one, China is reducing its oil imports. Two, we know that Libya is set to reopen all facilities. Its oil facilities have been shut since January due to attacks on its pipelines, due to high insecurity. And this is a country that was producing over 1 million barrels in 2019. Now, because of the shutdown in its production, as at August, was producing about 100,000 barrels. And now, with the resumption, we're bringing into the market about 260,000 barrels. This is coming at a time where your demand, the oil demand forecast is still faltering and still weak. So definitely, it's going to impact on the market, it's going to impact on prices, and it might even force other OPEC members and their allies to actually deepen their own output cost just in order to be able to support prices. And bear in mind, Libya is exempt from the output cost. So it's not going to be affected. It's definitely going to play or suppress oil prices. And the most potent risk is the risk of the rising infection cases globally. And we're seeing that because if that continues, we're going to see countries reimpose a lockdown. And you would even see some countries impose a precision lockdown, wherein it's certain cities that have been locked. And the impact of that may be more severe than the first lockdown that we witnessed earlier. And that definitely would impact on the demand and would impact on price.
And where's Nigeria in all of these, especially in terms of revenue?
So for Nigeria, we know that at least the over 65% decline in government revenue has been largely due to the plunge in oil prices, because that is our mainstay. And we're seeing that even other commodities are not faring as well. So definitely for Nigeria, it's a double whammy. You're experiencing lower oil prices. You are being forced to comply with your quota and being forced to reduce your production. So definitely your revenues would decline. And fine, we're seeing like in the FAC disbursements that were shared in September, it inched up marginally to about 682 billion naira. But imagine if we had higher oil prices, we would be recording FAC allocations about 700, 800 billion, because we've seen an improvement in VAT collection. We've seen an increase in import and export duties. But meanwhile, the petroleum profit taxes are reducing, all because of what's happening in the market. So definitely, it's going to play a significant role for Nigeria. And even also in terms of our reserves, the reserves keep depleting, despite the fact that now, again, the CBN is even increasing its forex supply. It has its regular weekly forex sales to the BDC. So it's going to, the impact on Nigeria would be significant.
Perhaps talking about our diversification drive now, we've seen cocoa prices also bearish on limited demand from Asia and US. So what are the implications of this for Nigeria's export earnings, especially as the country is seeking to improve its non-oil revenue?
Well, it's significant because, like I mentioned earlier, as in right now, obviously the government has this diversification strategy in place, and you're looking at non-oil exports. Cocoa is about our second largest non-oil export. And what we're seeing right now, because of the weak demand, again, that is affecting cocoa, weak demand from the US, from Asian countries, and even Europe, which is the region that consumes the most chocolates. They're also recording an increase in infection cases, which is also affecting demand. So definitely, we're seeing cocoa prices soften. And even the two largest global producers of cocoa, I'm talking about Ivory Coast and Ghana, they are also trying to put in place measures that would mitigate the impact of this weak demand on their farmers. So for instance, they've increased the farm gate price by about 21%. And the farm gate price of cocoa is the price at which cocoa is bought from the farmers. So they're just doing that basically to offset the impact and improve livelihoods of these farmers. Some would even term that this move is political, because these countries have their elections coming up. So Ivory Coast's election is next month, Ghana's one is in December. So they are doing this, and again, it's going to be short term. But for Nigeria, Nigeria is a price follower. So irrespective of what is even happening in our own cocoa production industry, well, it's not going to have that much of an impact. So for instance, now, we know that the rains have been delayed to around September, which is affecting harvest. And also because cocoa pods, they thrive when there is sunshine. So because the rains have been delayed to now, we're seeing that there's not enough sunshine to dry the cocoa pods, and that has become a breeding ground for the black pod disease, which is affecting our output. So again, the double whammy situation, we're experiencing lower production, global prices are fluctuating. So it's really a dicey situation for the Nigerian fiscal revenue position, and we're going to see that continue at least for the rest of 2020, maybe even 2021.
But then we just hope that things get better. Well, let's talk about gold now. Of course, spot gold has slipped below $1,900 an ounce on stronger US dollar. But are there any implications for Nigeria as well?
Yes, so Nigeria has some gold deposits, especially in Zamfara, and we have gold reserves of about 200 million ounces. And we know that, fine, that industry is largely artisanal and it's not as regulated. And so some of the challenges being faced in that or being encountered in that industry. So you have smuggling. Nigeria has lost about $2 to $3 billion in the last between 2012 and 2018, basically to smuggling, and the fact that because most of the gold producing states are predominantly in the north, so obviously insecurity has been a major issue. With that said, the government has put in place some measures basically just to develop that industry. So for instance, there's the Presidential Artisanal Gold Mining Development Initiative, which is basically targeted towards the mining, processing and refining of gold. And what the government is trying to achieve is, okay, fine, as we mine this gold, process and refine it, let's get to the point where we can start exporting it. And obviously, if you can start exporting gold, that would obviously boost your export revenue. That would also show up your external reserves, because you can also have gold as part, gold deposits as part of your external reserves. The government will be able to get even royalties from there. And with gold prices, fine, they've fallen below $1,900 an ounce. But gold is down now, but it's not out because of its safe haven appeal. It thrives in uncertainty, and there's a heightened uncertainty right now because of what's happening in the market. And again, being a commodity, it fluctuates. Next week now, there's going to be a slew of headlines that will be released, stimulus talks about the U.S.-China tensions, even the U.S. election news that are going to be released. And all this would impact on the price of gold. And bear in mind, there's an inverse relationship between the U.S. dollar and the price of gold. So because the dollar has strengthened, that's why we're seeing a weaker price for gold right now. So if these news that are being released, these points and facts that are being released in subsequent weeks affect or dampen the price of the dollar, obviously we'll see a pickup in gold. So for instance, the Chicago Federal Reserve president has stated that there might be a possibility of an increase in interest rates earlier than anticipated. Now, if that happens, that would push the value of the dollar higher to strengthen the dollar, and begin based on the inverse relationship, it makes gold less competitive compared to interest-bearing investment. So for Nigeria, despite the fact that the industry is still underdeveloped, but now is the time to benefit from it. And even if, yes, by the time you put in place all these measures, the CBN has this gold buying program where it acts like an off-taker, basically to shield gold miners from price volatility. By the time you put all these things in place, the economy moves in cycles. Yes, we're experiencing uncertainty now, and prices are high. The recovery comes in, the price of gold may stabilize. But then again, in the time of uncertainty, when the price of gold increases and we have all these things in place in the gold industry, Nigeria stands to benefit from it.
Which is what we're all hoping for. Now,
Yes.
The CBN has come up with a raft of new guidelines and investigation into forex activities. Is this actually helping to stabilize the naira, which we're seeing at about 465 to the dollar at the parallel markets, even as the CBN is sustaining its forex sale to the BDCs?
Well, it just speaks again to what I mentioned earlier, that what the message of the central bank and the signals, they are sort of like contradictory. Yes, the CBN has been consistent with its weekly sales to BDCs, and to an extent that has kept the parallel market rate around 465, even as at yesterday, towards the end of yesterday, it appreciated to about 470. So definitely we're still seeing that. And again, what is driving the parallel market rate is speculative and arbitrage activities. Meanwhile, if you look at the IEFX window, you will see that also the rate has been trading within a tight band of about 385 to 386, basically because it's being determined by market forces. So when there is increased demand, obviously the price is affected when there's supply. So what right now, like I mentioned earlier, investors, due to the policy ambiguity and the fact that even your interest rates are not attractive, they are not incentivized to bring in their funds, and definitely will continue to play a role in the direction of the exchange rate.
All right, where are we now in terms of commodities price movement?
For the domestic commodities right now, you are seeing that the carbohydrates, so the likes of rice, yam, basically, we're still seeing high prices, and even the ingredients being used, tomatoes, onions, we're still seeing high prices. And again, because of the delayed rain, so the delayed rains affected harvest, so we're not seeing, obviously the output and the yield will be affected. So that's what we're seeing right now. And as we shift towards the planting season, definitely prices are going to remain elevated at the moment.
Thank you, Damilola Kibami, Head of Research at the FDC. Thank you for coming on the program.
Thank you, BC.
All right, let's just bring you more headlines now. And talking about the federal government has approved a $1.95 billion contract for a rail line project to link Nigeria to Niger Republic. The proposed rail line project is designed to connect Kano, Dutse, Katsina, Debia onto Maradi in Niger Republic. According to the Minister of Transport, Mr. Chibuike Amechi, the 248-kilometer line is intended to aid the transportation of crude oil. Besides the rail projects, a $3 billion contract has also been awarded for the design, manufacture, supply, testing, and inauguration of one railway crane for the purposes of clearing rail tracks during accidents. All right, let's bring in Edidiong Ewang to do a review of Wednesday's trading activities at the NSE. Good morning, Eddie. Let's have the numbers.
Good morning, BC. Well, the market sustained the positive sentiment seen in the last 4 sessions, and that was due to bargain buying in MTN Nigeria, Nigerian Breweries, and Zenith Bank. That lifted the all-share index by 0.50% to 25,783.02 points, while the market cap was at 13.474 trillion. Now, activity was higher yesterday as we saw 414.16 million units worth 6.28 billion naira traded in 3,793 deals. Sectoral performance was also very positive yesterday as all the sectors we track closed positive. The banking index was up 0.65% thanks to gains on Zenith Bank, UBA. Now for UBA, I would like to mention that the bank's chairman, Tony Elumelu, was among the 3 Nigerians listed in Times Magazine's 100 most influential people in the world. So hopefully maybe investors will react possibly to that. The consumer goods sector was up, industrial goods was up, insurance was up, while oil and gas was also up. But let's talk to Charles Fakruga, a stockbroker at Citico Trust and Investment. Good morning, Mr. Fakruga. Thank you for joining us on the program. I guess we've lost Mr. Fakruga there. But the oil counter, we saw gains from Mobil. Wando declined, but that wasn't enough to drag that sector down. Seplat was also up by 3.90%. At the unlisted securities market, that market was unchanged yesterday as the NSI was at 727.03 points, while the market cap was at 534.05 billion naira. We saw about 1.01 million units worth 2.27 million naira traded in 9 deals. Okay, let's talk to Mr. Fakruga. Charles Fakruga is a stockbroker at Citico Trust. Good morning, Mr. Fakruga. Thank you for joining us on the program.
Thank you for having me.
So yesterday, Dangote Cement had its facts behind the figures and sustainability plan. Now, how impressive was that to you? And do you think we'll see investors react to that stock today? Hello, Mr. Fakruga, can you hear me? Well, I guess we've lost Mr. Fakruga there again. The bond market yesterday was bullish as average yields contracted by about 9 basis points. Across the curve, we saw demand on the March 2050 and the January 2026 bonds. We had 31 deals on that counter worth 10.7 billion naira. At the Nigerian Treasury bills market, as we can see, that market was very quiet yesterday. We had only 4 deals on that counter worth 956 million naira. The Omo market too was kind of mixed yesterday. Although yields declined on that sector, we had 13 deals worth 28.00 billion naira. But hopefully, I guess we'll be able to talk to Mr. Fakruga and the fixed income analyst later.
Young, and we just hope that the market takes a positive direction at the end of the day. But stick around, we'll be coming back to you in just a moment to review the debt and currencies markets. And we'll also be crossing over to London to see what's happening there this morning. Just stay with us. Thanks for staying with us. Now, let's cross over to our London studio where Juliana Olayinka is waiting to tell us about this morning's major headlines. Good morning, Juliana. Chancellor Rishi Sunak will later unveil a plan aimed at minimizing further unemployment as stricter COVID-19 restrictions come into force. And these new measures are expected to replace the furlough scheme, which is set to expire next month. Does that come to many as a relief?
I would say yes, but we'll have to wait and see what the Chancellor unveils in these new emergency measures. He'll be doing that at 11:45 local time. And as you said, over the past couple of weeks, Chancellor Rishi Sunak has been under increasing pressure to extend or replace the furlough scheme, given the British government's questionable handling of the coronavirus crisis. I've got to say, the furlough scheme has really been applauded as being a competent, pretty well thought through policy scheme that has kept millions of people in work and paid. The government were paying 80% of people's wages from March. It reduced to 70%, and it is due to expire at the end of October. But of course, we are seeing a fresh new wave of coronavirus cases. New restrictions have been in place. This is going to really have drastic implications on the hospitality sector and tourism in particular. So the government said that they will reconsider, and they are going to have a look at how they can help people keep their jobs. So far, about 800,000 positions have been wiped off payroll since the pandemic. Furlough is still keeping about 5 million people in jobs. So it would be interesting to see what the Chancellor will say later this morning. There are suggestions that he will copy a model that is already being rolled out in Germany and France, where the government basically top up wages. So perhaps what the Chancellor will try and do is encourage employers to keep their staff on, but just on reduced hours, and anything that they cannot pay will be topped up by the government. There are other suggestions floating around, but we'll have to wait and see what the Chancellor says in the House of Commons.
Now, while we wait for that, a survey commissioned by the British Beer and Pub Association, that's the UK Hospitality and the British Institute of Innkeeping, has shown that nearly a quarter of UK pubs and restaurants may fold within 3 months without support. They predict that the new curfew rules, which could last for 6 months, will even make things worse. That's certainly more bad news, Juliana, isn't it?
It is more bad news. It's the same bad news we've had since March, but it is getting worse. A lot of the sector were just getting back on their feet. They had a rush of enthusiasm from August's Eat Out to Help Out. Wednesday night became the new Friday night in the capital. But now this 10 p.m. curfew, which I've got to say does come in tonight, is, a nail in the coffin. That's what a lot of hospitality groups have been saying. There are some businesses that say they simply just cannot survive. Where our studio is right in the centre of central London, and just a stone's throw away, Soho. That's a popular tourist spot. Well, it was before the pandemic. At 10 o'clock at night, that's when you really start seeing people go out. That's when they get their customers in, particularly the theatres and the comedy clubs that rely on those last minute, footfall to come into their stores, and now having to close at 10. And, Boris Johnson, the Prime Minister, was pretty clear when he said it's not last orders at 10. You have to be shut at 10, which means you're probably taking in your last customers at 8:30. It is seen as a crippling blow. The nighttime economy here in the UK brings in billions of pounds. It's said to employ over 3 million people. 54,000 people are employed by the nighttime economy here in London. So there are lots of calls for concern. Again, 6 months is what the Prime Minister said. There's no vaccine on the horizon anytime soon. So yes, it is devastating. But, there is always light at the end of the tunnel, and perhaps Rishi Sunak will be shining some of that light at 11:45 when he delivers those new measures.
Absolutely, Juliana, and we're all keeping our fingers crossed for that. But let's talk about another research, the annual Female FTSE Board report conducted by Cranfield University and sponsored by EY, showing that women are still struggling to break into the top corporate roles, including chair and chief executive, despite gaining more seats in UK boardrooms. Why is this still continuing?
Well, well, to put it quite bluntly, some would consider this a man's world. And definitely when it comes to the corporate world, men like to be surrounded by people that look like themselves, which is why the British government have set these targets. Alok Sharma, the business secretary, has said that he wants all boards to have at least 33% of female representation before the end of 2020. And the report does show that over the past 12 months, I believe the report is up to the end of June 2020, there has been some growth, but just not enough, really. I believe on the FTSE 100, so that's the top index, only 5 CEOs are female, so obviously 95 are male. So there is still a long way to go. They do point out that non-executive director roles are quickly filling up with women. 40.8% are female occupied at the moment. But the issue is you are more likely to hire somebody that looks like you. And that's a similar situation we have with racial injustices in this country as well. So I believe what the report is suggesting is that the more women we have at the top, the more likely they are going to be to put the ladder down for more women. But there are improvements, but there is a significant way to go.
Thank you, Juliana. We'll see you again in the afternoon. Well, let's get back to Eddie Diong for a review of the debt and currencies market. Over to you, Eddie.
Thank you, BC. Just before we go over this again, let's just talk to Babajide Sholanke, a fixed income dealer at FSDH Merchant Bank. Good morning, Babajide. Thank you for joining us on the program.
Good morning, Eddie Diong. Good morning. Thanks for having me.
So how was trading yesterday after the MPC's meeting, and how do you think that the decision will impact the fixed income markets going forward?
Thank you. After the MPC meeting announcement, communique read out, we can see the general policy direction of the central bank is to ensure that interest rate is low so that it can promote economic growth. So the impact on the market, what we saw was that everybody was trying to pick as much as it can be, peak in the market, and understandably given the fact that you have noticed the central bank is allowing the maturities to roll over into the system without rolling them over. That means they've been allowing significant injection into the system that actually increased liquidity conditions and created liquidity support for demand. And we saw that demand is very persistent, and we saw people buying bills, whether on treasury bills across the call. So going forward, we believe that impact of the MPC decision of the general level of interest rates, of course, the low environment will persist. And that, of course, will continue to put downward pressure on the rate in the market. And the biggest boost for that is the monetary policy stance of the central bank to allow interest rates to be low, to allow liquidity to be sufficient to create loans and spur demand for that will create economic growth.
Speaking about liquidity, yesterday the DMO had a bond auction. How was the turnout like?
Yeah, it was quite impressive. As usual, like I said, the liquidity condition is very, very significant. If you look at liquidity conditions going forward for the remainder of the year, for October, November, December, they are on an average of about ₦1 trillion each maturity from minimum maturity. So we saw that demand, and that demand came into the bond market as well. So for bonds and treasury bills, it constitutes significant demand for them with the downward pressure on the rates in those markets, in the bond and treasury bill market, for the general liquidity condition which is expected to be buoyant for the remainder of the year.
With the lower rates we're seeing in the fixed income markets now, isn't that likely to push investors away from that market to the equities market?
Well, it's a possibility because it's a normal trade-off. When we see in the normal traditional view of it, when we see a decline in fixed income rates, there's usually a movement of migration towards equity. But however, of course, we can see that equity market has kind of picked up. But that picking up of the equity market is still limited by the fact of the risk affecting the general economy in terms of the systemic risk, which is beyond companies, in terms of output good going forward. And that's the monetary policy of the central bank trying to boost that output good. So even companies listed on the floor of investing are still faced, with significant negative outlook in terms of the demand for their goods and services, given the COVID pandemic and the fall in income, high unemployment rate even the higher cost of production. You can imagine inflation rate jumped up to significant more than 50 basis points from 12.8 to 13%. Of course, followed by stock price increase, removal of subsidies that have led to higher stock price, increasing electricity tariffs, and other incidental costs. And so there's no real safe haven, basically. So we see that there will continue to be a balance based on the risk appetite of investors. So people that have high risk capital always approach the equity market. After that, to preserve capital, we stay with the risk-free environment on the government securities, which treasuries and bonds.
All right, Babajide, thank you for your input on the program. Enjoy the rest of your day. Babajide Sholanke is a fixed income dealer at FSDH Merchants Bank. We'll have to leave you there on the market review and hope for a positive trading day. Over to you, BC.
Thank you, Aditi Young. And that's where we end today's program. Thank you for watching. I am BC Adebayo.